On Tuesday, the Supreme Court will begin hearing arguments for the Biden administration's $10,000 student loan forgiveness program. Before they decide if the administration has the legal power to forgive student loans, they'll first have to figure out if the states and individuals that are suing the administration actually have a case in place. But with all of that being said, I think the most important thing when it comes to the student loan forgiveness is how it will affect inflation. We already know inflation is on a downtrend. I think that the student loan forgiveness decision will decide how fast that downtrend goes. Hey everyone, it's Jonathan here. Let's discuss this in a lot more detail. We're first going to start off by talking about student loan payments and compare that to how much the average college graduate makes to kind of get an understanding of the financial significance of student loan payments. So the average federal student loan balance is about $40,000 per borrower. At a 5% interest rate, that comes out to about $525 per month if you were on a standard 10-year repayment plan. Now, the average salary for someone with a bachelor's degree is about $80,000 a year. And that equates out to be about $7,000 a month pre-tax or about $5,000 a month after tax, so take-home pay. So student loans take up about 10% of the average college graduate's post-tax income. An income-driven repayment plan is usually the difference between the poverty level salary and your salary, which in this case wouldn't make that much of a difference. I believe it'll be somewhere about 8% of your income. So let's just, for the sake of the matter, call it 10% as well. So now since we have an understanding of how big of a chunk student loan payments take out of the typical borrower's salary, let's now discuss the current savings rate we have in the United States. So right now, the savings rate sits around 5% from data that we have from January of 2023, which is the most recent data. And that's off of its low of about 2.7% reading that we had in June of last year. And we are starting to see the personal savings rate start to move up, that's mostly due to recession fears. But even at 5%, it's still slightly below the rates that we were seeing before the pandemic hit, and significantly less than the savings rate that we had during the stimulus-induced COVID lockdown era as well. We are seeing pressure on savings rate, and this is mostly due to some of the inflation that we've had. You know, a lot of salaries haven't really kept up with the growth of inflation, so people are chipping away at their savings to make up the difference. So because of the pandemic, we did have a lot of excess savings, and the Fed actually did a study back in October where they said that the average household has about $18,000 of excess savings, which would cover about 3 years worth of student loan payments, given that each household only had one student loan borrower. So now we have kind of this picture of, okay, well, the average American's student loan payment usually takes about 10% of their income, but the savings rate's only at 5%. So if people have to start paying on their student loans again, that means that not only will they pretty much burn through their savings or their savings rate or their capacity to save every month, but they'll also have to dip into maybe even their excess savings or maybe start to curtail some of their spending and have to dig into their discretionary income to make those payments. What is the inflationary impact of the student loan forbearance that we've had over the past couple of years? I think because the average four-year degree holder usually has a higher salary than your typical American. I believe your typical American has a salary of about $60K a year, whereas your typical bachelor degree holder has a salary of about $80K, like we stated earlier. And generally speaking, when people have higher salaries, they usually have more discretionary income, just given the fact that the basic cost of life is usually the same for most people. Obviously, it would change if you have like a health condition or if you have children or things like that, but generally speaking, usually relatively the same cost. I think that really it plays a big factor in two specific sectors of inflation. And these are two that that has been on the Fed's like top of their hit list for the past couple of months. And one of those sectors is services. Service inflation is typically driven by a lot of discretionary spending. Think restaurants, travel, hotels. These have been the sectors that we have seen a lot of inflation in the past couple of months. And this is something that the Fed consistently brings up when we get new job reports. So the second sector is housing. I have to explain kind of how qualifying for a mortgage works to make this make sense. Usually when you try to take out a loan to buy a house, what they'll do is that let's say you have a $10,000 a month salary. Generally speaking, you're usually not able to borrow more than 50% of your income to be able to buy the house. And that includes all of your debt payments. So let's just say, for example, you had a $500 student loan payment. That means that your home payment couldn't be more than $4,500 a month. And then they'll do like some backwards math given your credit quality and your down payment to determine how much home you could afford. Over the past couple of years, as student loan payments have been in forbearance, a lot of mortgage lenders haven't factored in the fact that you do have to start making those payments at some point. So what they've been doing is that they've been qualifying people as if those student loan payments didn't exist, which only helped create the real estate bubble that we had during the pandemic. So we do know that housing inflation is coming down, mostly just due to the fact that we've had such aggressive Fed tightening cycle. But I also think that student loan forbearance did play a big role into that as well. So let's pretty much put all of this together. So if student loans are disallowed, I personally think that that will be a massive anchor to bring inflation down. And especially when it comes to services and housing inflation, as this will probably take away whatever discretionary income and excess savings that most people will have, or at least most borrowers will have. And like I said earlier, people who have 4-year degrees generally make more money and have more discretionary income than people who don't have 4-year degrees. So people who have college degrees generally have higher incomes. And because they have higher incomes, that also means they probably have more discretionary income. So I think that if the student loan forbearance is disallowed and payments resume, that will definitely help in the Fed's fight to get to 2% inflation. Now, if forgiveness is allowed, I think that even though the payments won't be as big as an anchor as if it's disallowed, I still think that it will definitely help to have payments resume, as that will, like I said, lead to less discretionary income. Just given the fact that even if the student loan forgiveness was allowed, it only pays off $10,000 worth of student loans, and the average borrower has about $40,000 of debt. So they will still be a big chunk of those payments that will still need to be made, and that money will probably have to come out of discretionary incomes. So overall, I think that payments restarting, whether or not forbearance is allowed, will be a good thing for inflation overall. So on this channel, we will be paying attention to a lot of the updates that are going on with the Biden student loan forgiveness, and I'll be back to give you guys updates on it. So if you haven't already, please hit the subscribe button. I know about 90% of you guys are not subscribed who are watching my videos. So please hit the subscribe, share it to someone who you think would get value from this video. I'll see you in the next one.